Sources of finance for SMEs in South Africa. Running and growing a small business in South Africa requires funding at different stages, whether you're starting up, expanding operations, or bridging cash flow gaps. Fortunately, there are multiple sources of finance available for SMEs. So, owner's equity, self-funding. The first and most common source of finance is your own money, known as owner's equity. This includes personal savings, money from family and friends, or proceeds from selling personal assets. It's a good option because it avoids debt and interest costs. The risk is personal. If the business fails, you may lose your savings. To bank finance, commercial banks remain a major source of funding for SMEs. Overdrafts and revolving credit, short-term solutions to cover cash flow shortages. Term loans, fixed repayments over a set period, useful for buying equipment or vehicles. Asset finance, bank pays for the asset and you pay them back in installments. Banks usually require a solid business plan, financial statements, and sometimes collateral. SMEs with strong credit histories have better chances of approval. 3. Government grants and incentives. South Africa offers a range of grants and incentives to support small businesses, especially those that create jobs. SEFA, Small Enterprise Finance Agency, offers loans, bridging finance, and credit guarantees. SEDA, Small Enterprise Development Agency, provides non-financial support such as mentorship, training, and market access. DTIC grants and incentives includes programs like the Black Industrialist Scheme, Export Marketing Incentives, and Manufacturing Competitiveness Enhancement Program. And YDA grants for youth-owned businesses, especially startups. Government funding often has specific criteria, such as Black ownership percentages, number of jobs created, or operating in priority sectors. For private equity and venture capital, if your business has high growth potential, private investors can be a good option. Angel investors, wealthy individuals who invest in exchange for equity. Venture capital firms invest in scalable businesses and help with strategy and networks. Private equity funds usually invest in more mature businesses to help them grow rapidly. The benefit is access to not just money, but also expertise. The trade-off is sharing ownership and control. 5 development finance institutions, DFIs. DFIs offer funding on more flexible terms compared to commercial banks. Examples include IDC, Industrial Development Corporation, funds manufacturing, mining, agro-processing, and infrastructure projects. NEF, National Empowerment Fund, focuses on Black-owned businesses and transformation funding. Land Bank for agricultural enterprises. DFIs often accept higher risk projects, but the application process is thorough and may take time. 6. Alternative and fintech lenders. In recent years, new funding options have emerged that are faster and easier to access. Online working capital loans, fintechs like Lula, Fondra, and Bridgement offer quick approvals based on bank statement analysis. Invoice factoring. Get paid upfront for your invoices, useful for businesses that supply corporates or government. Merchant cash advance. Repayment is linked to your card sales turnover, making it flexible. These options may carry higher interest rates, but can be lifesavers for urgent cash flow needs. 7. Crowdfunding and community funding. Digital platforms allow businesses to raise money from the public. Reward-based crowdfunding, supporters get a product or service in return, e.g. Thunder Fund. Equity crowdfunding. Investors get shares in your business, regulated under FSCA. Community stockvilles and cooperatives. Traditional savings groups that pool funds for investment. This is a growing space in South Africa, especially for creative projects, social enterprises, and innovative products. WED, supplier and customer credit. Don't forget trade finance. Supplier credit, negotiate longer payment terms with your suppliers. Customer deposits, secure upfront payments from clients before starting work. This is essentially interest-free financing that improves your cash flow. Key considerations before choosing finance. When deciding which funding option to pursue, consider cost of finance, interest rate, fees, and total repayment amount. Risk, collateral requirements, personal guarantees, and impact on ownership. Flexibility. Can you repay early? Can you increase or decrease funding? Purpose. Match funding type to your business need, short-term versus long-term.